Good morning. You're watching live market outlook for Monday, 16th of January 2012. The markets are healing the wounds after last Friday's shocking action of S&P that downgraded the 9 of the Eurozone countries, including France. That came quite unexpected, as some comments during the last week were saying that S&P confirmed that during at least this year there will be no downgrade for France particularly, and President Sarkozy commented this. While Friday's action showed something opposite. It started with the rumors of possible downgrade with no news released after the markets well reacted on this action, and finally confirmed that there was a downgrade and that put heavy pressure on euro, that spiraled lower and hit fresh 1.5 year low on late Friday session hours at 126.22. At the same time, dollar was bouncing strongly higher, while gold depreciated according to the fresh strength of the dollar that pushed briefly the yellow metal lower. The immediate action was followed on the even during the Asian session after Friday's fall, where the market after the move started to consolidate. However, further negative pressure, especially on euro dollar, with the opening lower in the Asian session, keeps the focus on the downside, as well studies on the technical part are also in the negative field. So further pressure on single currency would be likely in the short term, but some recovery is not ruled out, as markets, the euro actually against dollar fell heavily on Friday, so some correction and short covering would be likely, will be shown today. Also to mention that today's US holiday would in a way reduce the volumes in the markets, and as America is closed, so we might not see some spectacular actions today due to the Martin Luther King holiday in the US. From the today's events, a little shown on today's calendars. As I mentioned, the holiday in the US closes the biggest market in the world, and we're going to take a look on today's calendar. Already released from Japan, machinery orders monthly came in much better than expected. 5.8 was forecast, 14.8% today's release compared to the -6.9 previous month release. Right move HPI from UK, the release during the night, shows minus 0.8% compared to minus 2.7 previous month release, while Australian home loans monthly release showed a growth of 1.4% compared to 1% forecasted. German WPI came unchanged compared to 0.3% forecast for today, and the previous month release at 0.7%. Swiss PPI is due now. Actually, it's already released, so we're going to take a look on the Swiss PPI. Monthly reading is plus 0.3% in December versus minus 0.8 in the previous month, while forecast was minus 0.3%. From America's new motor vehicle sales monthly is due at 30.30 in Canada today, and US ECB President Draghi is due to speak at 1600 GMT today, and that would be all from today's calendar. As I mentioned, the America is closed for the holiday. Now let's take a look on the technicals and see the latest movements. As we see, Euro, after a strong recovery during the past weeks, rally from 126.60, regained levels close to 129. 128.77 was seen ahead of Friday's sharp fall that cleared 126.65, 126.60 previous lows, and extended losses to 126.22 so far. So far, no signs of a stronger recovery, as we can see that there was a gap lower opening on the Asian session during the night. However, the ground at 126.20 zone still holds the downside. We might see some corrective action as studies are bouncing now from oversold zone, and might trigger a bounce higher. 127 is the initial static resistance ahead of 127.40, where is the 4-hour 20 days moving average. For now, it's likely expected to cap gains on the upside. However, only break above 128.77, which is Friday's high, and its key near-term barrier would change the current negative structure in favor of stronger recovery. Holding below 128.77 keeps the focus on the downside, and the levels to watch are already mentioned in our previous sessions. 126 is the 76.4 Fibonacci retracement of the move from 2011 to 2010 to 2011, from 118.75 low of 2010 to 149.38 high of 2011, and then we have a break point at 125.86 low of 22nd of August 2010, loss of which would open way for a further weakness, and the focus 118.75 in the short to medium term. Between we have lows at 124.55, which is the low of year 2009, and 123.31 low of 2008, that are coming between this current levels and our key support at 118.75. For now, even the daily outlook maintains the negative structure, as 20 days moving average at 129 on daily chart caps the upside for now, and studies are firmly in the negative territory. The British pound also continues to channel lower from the yearly high at 156.68 posted on 4th of January. We can see the steady move lower. Loss of important and I would say key supports at 153.60, which was the previous range floor, and 152.71 low of 2011 posted on 2nd of October. Extended so far to 152.33. This was the low of today on on Friday, ahead of ahead of a brief recovery attempt. The outlook remains negative for sterling, as 153.80, the main bear trend line drawn of 156.68, currently at 153.80, and 154 zone, where also 38.2 Fibonacci retracement of 156.68 to 152.33 stands, is expected for now to limit the upside. Also, we have where the gains are expected to be capped for now, as the dominating bears are still keeping the focus at the downside. Loss of 152.33 would open way, as this is the pair is already below the longer term range floor that was around the 153 zone. Now the break here would likely open way for a fresh phase lower, and the 150 zone would be in the short to medium term focus for British pound. On the upside, as mentioned, 153.80, 154.08 offers initial barriers. However, only regain of 155 level zone would provide the temporary relief and open way for a stronger recovery. Until then, any bounces from current lows would be seen as corrective ahead of further extension lower and possible movements towards 150 zone, our next short-term target. Dollar yen again, unsuccessful attempt higher resulted in overnight's spike to 77, our initial barrier, where the gain stalled, and the pair is back to the narrow range that is limited by 76.65 and 77.00. 76.65 is temporary support, higher low of last Thursday and Friday, ahead of a more significant and stronger support zone at 75.60.50, which is the lows, which are the lows of 4th of January and the 18th of November 2011. And this is actually our key support. Loss of this level is to open way for further weakness of the pair, and 76.10, 76.00 are initial targets ahead of historical low and pre-intervention low of 75.56. Again, just to mention that Bank of Japan might react. They are waiting to see the further development of the pair, and possibly loss of 75.60 would be 76.50, pardon, would be good signal for Bank of Japan to take an action. Nothing confirmed, but just the intervention is still pending. On the upside, 77 as initial resistance, and 77.20, which is 90 days moving average on daily chart, that currently limits the upside, with 77.32 high of 6th of January, break of which is required to open way for stronger recovery, and the mark bottom at double bottom at 76.50, 76.65, and possibly open 78.20 for test in case of a firm break higher. The dollar Swiss has regained the ground after heavy losses, dipped to 94 zone. This is 20 days moving average of on the daily chart that for now contained the dips, and the strong rally on Friday created the double bottom pattern with 95.73 high seen so far, just ahead of our key barrier at 95.93 high of 9th of January. Oversold, overbought conditions on the 1 hour chart are looking for some corrective action. That is already happening with the initial support of Friday's intraday low at 95.16, with the 95 expected to contain the reversal where the also 20 days moving average on 4 hour chart stands. That would be ideal reversal above 95 to resume the latest rally. A break above 96 barrier actually is required to end this corrective phase from 95, 93, that bottomed at 94, and signal the resumption of the broader uptrend of dollar Swiss that lasts from August 2011 and from 70.67 record low of dollar Swiss. A failure to clear 96 might result in further ranging and consolidation here, while the loss of 95 would be risky for a possible reversal down to 94.00, which marks our key near-term support level. Quick look at commodities. Gold was at the back foot last Friday due to stronger dollar, but support was found at 16.25, and the fresh strength is now underway. The hourly studies are again turning into positive territory, with 20 days moving average now supporting the latest rally, and the more significant 1600 support zone stays intact for now, signaling further extension of the latest up leg from 29th of December low at 1522. Clearance of previous high at 1662 posted on last Thursday is to open a next level, which is Fibonacci at 61.8% at 1670, and resume a current recovery. 200 days moving average has so far contained dips, and holding above this one, currently standing at 1636, keeps the positive structure of gold in the short term from 1522 in play, with the next the dynamic resistances at 1681.55 days moving average, and 1689 90 days moving average, ahead of 1692.60, which is the main bear trend line drawn of 1920 high. On the shorter term outlook, initial support is now at 1625 low of last Friday, while 1600 our key short-term support needs to hold the downside. Otherwise, loss of this level would weaken the structure, as the broader outlook for gold still maintains bearish tone, and basically it's now we are seeing attempts of breaking this first barrier at 200 days moving average. Hasn't been clearly taken yet, but holding above here keeps the positive tone for a further extension, with the break above trendline resistance to confirm for possible extension up towards 1763, previous high posted on 2nd of December 2011. Crude oil February contract that expires in a couple of days is near-term action is in defensive after hitting a recent high at 103.72, with series of lower highs at 103.39 and 102.96, and the latest steep decline from last Thursday, extending losses below 100, which is our reference, dipping so far to 97.69 low seen last Friday. Recovery attempt is now underway, but also gap lower opening overnight keeps still the pressure on the crude oil. Initial static resistance 100 and 100.17 last Friday's high, above which comes 155 low of 11th of January 2010. From Fibonacci levels of the latest down leg from 102.96 to 97.69. Also, we have 38.2 Fibonacci retracement close to $100, and above 117, 50% retracement comes at 100.32. Break above 101 is required to refocus higher levels. Otherwise, we might see reversal and possible further extension, as the pair still the pair's short-term outlook remains in the negative field and favors further the downside. Loss of 97.69 low of last Friday has the next target at 96.79, with possible extension down to 92.70, not ruled out in case of break lower.